Let's turn to Jim Bianco, the president at Bianco Research. Jim, the data, 27 minutes away, sir. What are you looking for?
Whether or not we actually have that downside surprise, because I think so many people are so bared up on inflation, 0.5, 0.6, 0.7, and what kind of a reaction we have on the downside. Now, I suspect it's not going to be much. Jonathan, let's back up a quick second, and let's remember here. These inflation numbers, nearly a 7 handle what we're expecting, is way out of the park from what everybody thought we were going to see in the spring. This is arguably one of the worst macro calls by the consensus in history, that they've missed inflation so bad right now. And the only saving grace is that the stock market hasn't responded to it yet, but short rates are responding to it. And they've got 3 rate hikes priced in for next year, possibly a 4th in the spring of 2023. So when we talk about, the Bank of America call that maybe the Fed have to slam on the brakes, that's becoming more and more of a reality if you look at short-term interest rates. And that's going to be the biggest concern going into 2022. Did we blow this inflation call so bad that the Fed has no choice but to slam on the brakes? And that's what short rates might be telling us.
Well, Jim, when do we know that, right? I mean, we keep hearing strategist after strategist talking about the hump of inflation, how it's temporary, talking about their faith in an idea that the Fed has kind of walked away from very slowly to say, look, we kind of got it wrong. When do we know that this trend has a longer lasting tail?
Oh, I think it already does have a longer lasting tail. I think most people are arguing it incorrectly, by saying that inflation will peak in the next month or two. The question is, how long is it going to take for inflation to get back down, say, under 2.5%? And if you look at the shelter components or OER, owner's equivalent rent, at least a year, if not 2 years, is where you're going to go before you actually see it come down a lot. And I think more and more the bond market is going to get more uncomfortable and impatient with this. And the other thing to keep in mind, I know a lot of people focus on the stock market. Well, stocks are at all-time highs, and that's kind of the arbiter of every conversation. The S&P's up, so it's not a problem. At major turns in the last 20 years, the last market to respond to all major turns has been the stock market. In 2001, the stock market was the last to move. In 2007, it was the last to move. In the spring of 2020, the bond market was on fire, and yet the stock market did not pay attention to it, and then eventually it did. So if you're looking for the stock market to be the leading indicator of when the inflation problem is going to be, I think you're looking in the wrong place. I think you got to look to the bond market. And these rising short rates and the flattening yield curve, which is also, I think, a very worrisome sign that it's suggesting that the Fed's going to make a policy mistake. Usually the Fed raises rates till they break something. Yeah. And the flattening yield curve is suggesting that it won't take much to break something, maybe just to move to 1%, and we'll start seeing breakage.
Well, and let's talk about, too, the efficacy of Fed action, because where you think about a lot of the inflation is being derived from, it's the supply chain. A lot of people say, oh, that's going to ease up early on in 2022. You think that's wrong, yet the Fed isn't in a position to do anything about supply-side-driven inflation. So where does that leave us? Yeah,
I think that, in second place of the bad calls for this year is the call that the supply chain will fix itself magically. If you look at what's been happening with the supply chain, they're just playing games with the numbers. They're moving the ships 150 miles offshore to say that the backlog is coming down, but it's not. It's the worst it's ever been. And then we kind of quip that the Fed can't print ships. But what we also have is tremendous demand. We have record demand for durable goods and retail sales right now. And if the Fed wants to raise rates, they could help bring the inflation picture back in the line by helping to cool off the demand side of the equation. It is not just supply that is causing this inflation problem. It is supply and record demand at the same time, and the Fed could do something about demand if they wanted to.
Well, let's talk about what they can do. There's been a bigger conversation recently, Jim, on this program and elsewhere in research about the sequencing. If it's a straight transition from tapering straight over to rate hikes, does balance sheet reduction come into this, Jim? How are you thinking about that one?
Yeah, I don't think the Fed is quite ready for balance sheet reduction, but they'll probably double the taper next week. That'll get them in pace to be done with the taper by March. The market's pricing in a 40% chance that the first rate hike is going to be in March and a 60% chance it's going to be in May. I know that most of the consensus is not there yet, but I think that, when you talk about sequencing, we're going to speed up the taper so it can open the door for the first rate hike to be in March, and that will set the stage for at least 3 rate hikes in 2022. And maybe a 4th in the spring of 2023. And then we'll have to see whether or not that is too much for the economy to handle. And like I said, I think the flattening yield curve is worried that it might very well be too much.
Jim, you said earlier the bond market is going to get more uncomfortable. What does that look like?
Well, right now, if you look at measures of liquidity in the bond market, it's probably as bad as it's been since the spring of 2020. Now, of course, the spring of 2020 was about the worst ever right now. So you're seeing lots of jarring and erratic moves in the bond market. You know, the 10-year yield earlier this week shot up 20 basis points before it backed off a little bit. The 2-year note will have 10, 15 basis point moves in a day. These are gigantic moves relative to what we thought the bond market was doing as well. So the illiquidity in the bond market is growing, and it's going to be more problematic as the biggest player in the bond market, the Federal Reserve, continues to exit through its taper.
Jim, just quickly, 6 handle or 7 handle at 8:30?
So I'd probably say a 7 handle at 8:30. I think that it's so close to it with the consensus right now.
Jim Bianco, as always, good to see you, Jim. Jim Bianco there of Bianco Research, looking ahead to 6.